We're going to make a lot of mistakes at Berkshire, and we've made them in the past. We'll make them in the future.
People learn from mistakes, but rarely do they make money on them, especially investors. Why get your own kicks if the legendary Warren Buffett has already walked this path and shares 10 mistakes that nearly every investor makes? At the end, you'll learn about the mistake that cost his company $10 billion.
Charlie and I don't think about the market, and Ben didn't very much. I think he made a mistake to occasionally try and place a value on it. We look at individual businesses, but the stock market, I know of no one that has been successful at, and really made a lot of money predicting the actions of the market itself. I know a lot of people who have done well picking businesses, and that's what we're hoping.
Predicting market movements is such a tempting idea. Every investor would like to buy the dips and sell the highs. But Buffett advises everyone in life and in investing to focus on two things: the important and the knowable. Where the market will go is important, but is it knowable? Pandemic, high interest rates, wars. These are just a few of the hundreds of possible factors that the market depends on that cannot be foreseen. Instead, Buffett suggests doing only what is both important and knowable at the same time, picking great underestimated companies. Instead of trying to avoid the hurricane, focus on picking a solid ship.
A stock at 50, somebody's paid 100, they feel terrible, somebody else paid 10, they feel wonderful, all these feelings. And it has no impact whatsoever.
A temporary price drop during a bear market shouldn't be your concern. The only thing that matters is whether the companies in your portfolio are good and will continue to generate cash flow in the future.
I think it's a mistake for any company to predict 15% a year growth, but plenty of them do. Very, very few large companies can compound their earnings at 15%. It isn't going to happen.
Has there ever been a case where you see a fairly expensive stock, but you still want to buy it because you think he will keep showing staggering growth? But from his vast experience, Buffett warns that expecting high growth rates is a wrong approach. Between 2012 and 2022, on average, only 1 out of 10 companies grew by 15% or more. So you should invest in companies that have already shown significant growth with caution.
Really, the only way a smart person that's reasonably disciplined in how they look at investments can get in trouble is through leverage. I mean, if somebody else can pull the plug on you during the worst moment of some kind of general financial disaster, you go broke. And Charlie and I both have friends that have where that's happened to them.
Investing is an activity for the patient. You may be accurate in your predictions of price movements, but using leverage, you're unlikely to get a profit from your predictions. Sooner or later, the margin call happens. It is a losing strategy or the long haul.
We've made plenty of mistakes in acquisitions, plenty. But the mistakes are always about making an improper assessment of the economic conditions in the future of the industry or the company. They're not a bad lease. They're not a specific labor contract. They're not a questionable patent. Those are not the things that count.
It is said that Buffett can analyze a company in 15 minutes. This is due not only to his vast experience, but also to the fact that he tends to simplify everything. He analyzes 3 main things: the future of the industry, the management of the company, and the stock price. In 15 minutes, he is unlikely to understand every single detail of the business, but these 3 main things allow him to make a decision. If you get caught up in too much detail, you can miss the forest for the trees.
Some businesses are a lot easier to understand than others. And Charlie and I don't like difficult problems. You know, I mean, we'd rather multiply by 3 than by pi. I mean, it's just easier for us. Some people think that if you jump over a 7-foot bar, that the ribbon they pin on you is going to be worth more money than if you step over a 1-foot bar. And it just isn't true in the investment world at all.
The tricky thing about investing is that while in life people are rewarded for great effort, investing is almost the only area where the opposite is true. Making complex calculations or analyzing the future of the industry is not only unhelpful, but is often disastrous for your investment results. Simple ideas yield exceptional results in the long run in the investment world.
If you feel you have to invest every day you're going to make a lot of mistakes. It isn't that kind of a business. You have to wait till you get the fat pitch.
Which tennis player do you think will be more successful? The one who trains 5 times a week or the one who trains 5 times a year? Obviously the former. Now the same about investors. One buys 5 stocks a week and the other buys 5 stocks a year. And this is where everything is reversed. Investing is that rare area where inaction is rewarded. You can't buy shares of great companies every day at a fair price. Buffett says that an investor must behave like a baseball player who cannot possibly strike out. You don't swing at every ball that is thrown at you. You must wait for the far pitch.
We think the most logical fund is the one we have at Berkshire, where essentially we can do anything that makes sense and are not compelled to do anything that we don't think makes sense. I think it's a mistake to shrink the universe of possibilities. Ours is shrunk simply by size, but we don't set out to circumscribe our actions in any way.
Opportunities never stick in one place for long. And you never know where they will appear. So don't narrow down your universe of opportunities to one industry or sector.
If you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money. And I will guarantee you that going into a 7th one is going to, rather than putting more money in your first one, it's got to be a terrible mistake. Very few people have gotten rich on their 7th best idea, but a lot of people have gotten rich on their best idea.
For instance, Buffett calls diversification a shield against foolishness. That is, protection against the fact that an investor is not very careful in choosing stocks and may choose the wrong companies. But if there is a lack of expertise, it is better not to buy shares of a certain company at all, but to invest in index funds.
Humans will continue to make the same mistakes that they have made in the past. I mean, they get fearful when other people are fearful. I mean, but when they get greedy en masse too. I mean, that's where Charlie and I have an edge. We don't have an edge particularly in many other ways, but we are able, perhaps better than most, to not really get caught up with what other people are doing.
Based on previous mistakes, you should have already noticed that the art of investing is often at odds with common sense. As another prominent investor, Howard Marks, says, what's clear to the broad consensus of investors is almost always wrong.
There's no question the human mind, that what the human being is best at doing is interpreting all new information so that their prior conclusions remain intact. That is a talent everyone seems to have mastered. And Charlie and I have made big mistakes because, in effect, we have been unwilling to look afresh at something. That happens.
This is a mistake that is extremely costly to investors. We love to search for and interpret new information to prove our previous guesses. But Buffett says we need to do the exact opposite. Stay rational and consider the pros and cons of each company in our portfolio.
The biggest mistakes we've made, by far, are mistakes of omission and not commission. I mean, it's the things I knew enough to do. They were within my circle of competence, and I was sucking my thumb. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing.
Nearly each of the previous mistakes was based on some sort of action. However, as Warren himself says, sometimes the biggest mistake is not doing something. Buffett once said one of his biggest investment mistakes was not investing more in Walmart when he had the opportunity. Berkshire first bought Walmart stock in a range of $23, and Buffett over the years has commented several times on the thumb sucking that kept him from buying more as the price rose. A mistake he estimates cost Berkshire $10 billion. Like this video and subscribe if you found it useful. Check out our other videos as well.